Welcome to the deep dive. This is where we take those really dense, time-sensitive intelligence briefings, grab our shovels, and just dig until we hit gold. We're hunting for those critical insights you need to be truly informed. And today, our mission, well, it's all about decoding the pre-market picture for October 14, 2025. We're using the Bills, Bears, and the Bell Morning Edition Market Intelligence Brief. So good morning and welcome to the brief, and thank you for joining us as we try to unpack what looks like a pretty high-stakes moment here. Now, if you just glanced at the big indices this morning, the Dow, S&P, NASDAQ, you probably think, okay, a standard risk-off day, maybe even panic. But the deeper you dig into this material, the clearer it becomes that today's session is actually defined by this really extraordinary divergence. It's fascinating. It feels like a battlefield, doesn't it? You've got this widespread macro-driven caution, that sort of base layer of fear clashing head-on with really intense, very concentrated activity driven by specific, sometimes even geopolitical catalysts. It's just a perfect illustration of that macro-micro disconnect we talk about sometimes.
It really is. And that disconnect, well, that's precisely the challenge for you, the listener, today. We are navigating what the brief explicitly calls a two-track market. On one track, you've got this palpable global risk aversion. It's a fear driven by inflation worries, rising recession odds, and just crippling uncertainty about what the central banks are going to do next. That track. It's driving futures lower everywhere. Asia, Europe, the U.S. But then there's the second track, and often it seems to be operating completely independently of the first one. Here you've got these explosive, catalyst-driven rallies happening, incredibly niche sectors, especially critical minerals, as we'll see. So the big question for today, really the question for the whole session, is which track wins? Which one maintains control? Does that crushing weight of global macro fear eventually just pull everything down, drag down those high-flying individual stocks, kill investor confidence? Or are those micro rallies strong enough, thematic enough, to actually start sparking a broader reversal, to challenge that fear narrative? You absolutely have to understand both forces at the same time today. Because acting on one without acknowledging the other, well, that seems like a recipe for a pretty big portfolio mistake.
Okay, so let's start with that first track then. Unpack the macro mood. It's the essential baseline, right? The anxiety the market is starting with. And the source material, this briefing, it's very clear. Caution is pervasive, it's global, and the signal is, well, pretty unambiguous for a lower open in the U.S.
That's exactly where we begin. The fact that it's globally synchronized negativity, that's what makes this risk-off tone so striking. It sort of locks in this heavy psychological headwind before the opening bell even rings in New York. If we look at the U.S. specifics, index futures were all signaling pain, but interestingly, at sort of varying degrees of intensity. Dow Jones Industrial Average futures, they were down, 268.80 points. That's a loss of 0.58%. S&P 500 futures showed a steeper drop. They were down 58.75 points, or 0.88%.
But the real canary in the coal mine, like it often is when rates and growth fears collide, seems to be tech. The NASDAQ 100 looks like it's taking the biggest hit here.
Absolutely. The NASDAQ 100 futures had the steepest decline, down a pretty substantial 281.50 points. That translates to a 1.13% drop. Now, why the outsized sensitivity? While this underperformance in the tech-heavy index, it really suggests investors are highly sensitive to two key things right now. One, interest rate expectations, because, high rates disproportionately hammer the valuation of future profits for those growth stocks. And two, global growth concerns. Since so many major tech companies are global players, right? A worldwide slowdown hits their forward revenue projections instantly. So they're the most interest rate sensitive and the most globally exposed. A double whammy today.
And this wasn't just a U.S. thing driven by maybe worries about inflation data here. You mentioned it was global. Were European and Asian traders reacting to the same kind of domestic fears, or is this sell-off synchronized for, a different shared reason?
That's a great question. And the answer really confirms the global systemic nature of the fear. The weakness kicked off overnight. It set a decidedly negative precedent. Asia closed sharply lower. Japan's Nikkei index was down, a punishing 2.58%. Hong Kong's Hang Seng Index fell 1.68%. So that weakness immediately fed into the negative sentiment rolling into Europe. And when we checked European futures earlier, the picture was identical. Germany's DAX futures tracking down about 1.00%, France's CAC 40 lower by 0.85%, and the pan-European Euro Stoxx 50 index futures also pointing to a loss over 1.00%. This synchronization, it really points to a shared global concern, probably about persistent sticky inflation and this growing fear of it, synchronous economic slowdown across major economies. And that's much harder to escape than just a localized downturn,
Okay, so a globally synchronized sell-off sets the stage. But then there's the VIX. That spike tells us something really critical about the intensity of the fear, doesn't it? Let's talk about the CBOE volatility index, the market's quote-unquote fear gauge.
Yeah, the VIX reading is maybe the most quantifiable sign of that anxiety we were talking about, and it is flashing red this morning. VIX futures were trading at 22.05. Now, that represents a really substantial single-session jump of 24.57%. The spot VIX was right there, too, near 22.08. This jump is crucial. It's more than just a number going up.
So for listeners who might not track volatility metrics every single day, what does a VIX level over 20 historically mean? And why should we care that it's spiking this sharply before the market even opens?
Right. So a VIX above 20, that's historically the threshold. It's associated with heightened market stress, massive uncertainty, and a much higher probability of large, sharp price swings, both up and down, by the way. The VIX essentially measures the implied volatility of S&P 500 options. So when it spikes like this, it signals a kind of frenzied demand for portfolio insurance. Think about it practically. A VIX above 22 means institutional traders are actively out there buying options contracts, specifically deep out-of-the-money put options. Why? To hedge against severe, sudden downside risk, they are literally paying a premium to insure their portfolios against a potential crash. It tells you that institutional confidence in the market just holding steady is extremely low right now ahead of these big events. They're bracing for, well, potentially extreme turbulence.
Okay, fear gauge, flashing red, signaling volatility, uncertainty. Got it. But fear is only half the story today, isn't it? That turbulence you mentioned, it's going to be driven by the actual catalysts hitting the wire today. And our sources, this brief, highlights two primary drivers acting as immediate sort of gravitational centers for the market: corporate earnings and macroeconomic signaling. The day's direction really hangs on how these two forces play out.
That's absolutely right. The market isn't just, reacting to yesterday's news or lingering fears. It's bracing for an immediate, heavy onslaught of new information that could instantly shift the trajectory. This isn't going to be a slow drift today. It feels more like a news-driven collision course.
And the economic calendar is just jammed, packed, making volatility almost a guarantee, you'd think. We had that European data early this morning kind of setting the scene. Germany's ZEW economic sentiment, Euro area industrial production, gave us an early read on Europe's health, which, well, looked like it was already showing some strain.
But the real wild card, the unquantifiable risk, as the briefing puts it so well, comes from the Federal Reserve speeches. I mean, the market reaction to multi-billion-dollar corporate earnings could be totally overridden by a single sentence, maybe even a single word from a central banker today.
Exactly. And we've got a whole battery of high-profile speakers lined up throughout the day. We're expecting to hear from Fed Chair Jerome Powell, Governor Bowman, and Governor Waller. What makes these real-time speeches so, well, dangerous right now?
The market is currently just highly sensitive. Some might even say ridiculously sensitive to every little nuance in central bank policy language. Investors seem terrified of two main things. A policy mistake. The Fed keeps rates too high for too long, basically guaranteeing a recession. Or B, a sudden, maybe premature pivot to dovishness, which could suggest they know something the market doesn't know about, a really severe, imminent economic decline. The sources stress that any unexpected hawkishness, meaning the Fed signals inflation is still a big problem, they need to keep rates higher for longer. Or, conversely, any surprising dovishness, suggesting maybe they're thinking about a pivot. Either one could instantly override whatever sentiment was established by the futures or even the initial reaction to earnings. Policy signaling is just the quickest path to a massive market U-turn today.
Which brings us right to the gravitational center of today's news flow, Q3 corporate earnings. Today is described in the brief as a critical inflection point, and it's centered squarely on those major financial bellwethers.
This is truly a crucial morning for assessing the health of the U.S. financial system and, by extension, the economy. The list of major companies reporting pre-market is, well, staggering. It includes the big four commercial and investment banks, JPMorgan Chase, that's JPM, Goldman Sachs, GS, Wells Fargo, WFC, and Citigroup C. Plus, you've also got BlackRock, the huge asset manager, and the healthcare giant Johnson & Johnson, J&J, all reporting too. It's a packed morning.
And we really need to emphasize this. The collective results from JPM, GS, WFC, and C, they aren't just bank reports today. They're universally viewed as a kind of live macroeconomic data release.
Why is the banking sector considered such a vital proxy for the entire U.S. economy? Because they simply have the most comprehensive, most real-time pulse of the American consumer and American business. Think about it. Their lending activity, their view on consumer credit risk, their pipeline of corporate deal-making. It gives us the most granular, up-to-the-minute assessment of the financial state of U.S. households and businesses. way before any official government data comes out, which is often lagging. So if they sound optimistic today about loan demand, about credit quality staying strong, that early sell-off might reverse sharply. But if they confirm the macro fears, if they say high rates are starting to crush the consumer, we could see the decline accelerate really rapidly.
Okay, so if we're putting on our institutional investor hats now, we need to know what they're actually going to be scrutinizing in these bank reports. It's got to be beyond just the headline revenue and earnings per share figures, right? Let's do that deep dive into the specific banking metrics that truly matter today.
Right. This is where we move past the sort of simplistic headlines you might see scrolling by and get into the granular, forward-looking data that actually moves the big money. The market reaction today, it's going to be driven entirely by these nuanced details and, maybe even more importantly, by the management commentary and the forward guidance they give for the next few quarters. First and foremost, we absolutely have to watch loan loss provisions, LLPs. I would argue this is probably the single most important leading indicator coming out of these reports today. This is the money banks set aside now to cover potential bad loans they expect down the road, in the future.
And why does that specific number carry such immense weight? What makes it so predictive?
Because it represents the bank's own internal forecast. Think of it this way. If you see a sharp increase in these provisions, it's a clear signal that the bank's own CFOs, their own risk management teams, are anticipating a significant rise in defaults. Across their loan books, mortgages, credit cards, auto loans, business loans, it's the bank's internal confirmation, if you will, of a weakening economic environment and elevated recession risk. It's a much more chilling forecast, potentially, than any generic economic indicator we might get later, because it means the people who know the consumer best, the actual lenders, are expecting things to get rough, and they're booking that expected loss today. If that LLP number comes in significantly higher than the consensus estimate, the market will likely treat it as confirmation that a recession is becoming much more likely, maybe even imminent.
Right, it's like a forecast baked right into their balance sheet.
Okay.
Next up, we have to look at core profitability, especially in this high-rate world.
Yeah.
Net interest income, or NII, and the associated margin, NIM.
Absolutely. Commentary on NII and net interest margin guidance is critical because it reflects the bank's core profitability engine lending. In simple terms, NII is just the difference between the interest banks earn on their loans and the interest they have to pay out on deposits. Now, for the last year or so, high central bank rates have actually boosted NII for many banks. But that margin, the NIM, is now under pressure. Investors desperately want to know, do banks expect margin compression going forward? Meaning, are their funding costs, what they have to pay depositors to keep their money, rising faster than what they can charge borrowers? Or do they still see some room for margin expansion in the coming quarters? Any significant weakness in NII guidance will be viewed very negatively. It'd be a signal that the easy gains from just riding the higher rate wave are over and profitability might be stalling out.
Okay, and then there's the direct read on the U.S. consumer's actual health. Forget the abstract unemployment rate for a second. We're looking for direct transactional data right from the bank's books, aren't we?
That's exactly right. We need specifics on credit quality and consumer health. We're looking for hard data on the financial resilience of the average consumer, under the pressure of high inflation and high interest rates. That means focusing explicitly on things like credit card delinquencies. That's often the first debt people stop paying when things get tight. Also, the performance of auto loans. And just the general demand signals they're seeing within mortgage and home equity applications. Are consumers starting to buckle under the cumulative pressure? Bank reports give us that real-time usage data, not some lagging government survey. That's why they're so incredibly valuable today.
And finally, the critical gauge for corporate deal-making and the overall health of capital markets. Where do we look for that signal?
For that, we look primarily to Goldman Sachs and JP Morgan's investment banking and trading revenues. While the commercial lending side tells us about consumer health, the IB and trading divisions provide that direct, live read on corporate confidence. We need to see if the ongoing drought in M&A activity in IPOs is finally showing any signs of easing. Weakness here would indicate that CEOs are still too uncertain about the future economic environment to pull the trigger on major corporate deals, which, signals low forward confidence among big business leaders. Strong trading revenues, however, could be a key offset. It might reflect that the volatility itself is providing opportunities, even if M&A remains sluggish. So you have to look at both pieces.
And just to put all this into context, today is definitely the inflection point, but the source material reminds us this heavy earnings flow keeps coming all week. We've got Bank of America, Morgan Stanley, the later Tesla, Netflix. They're all coming up. So today really sets the critical, potentially very volatile tone for what's going to be a long and high-stakes reporting season.
It's just the opening salvo, exactly. But now, let's transition, because we have to talk about the other track of this two-track market. This is where the real drama and, frankly, the explosive returns are happening right now, the micro action.
Ah, yes. This is that massive divergence we kicked off with. The overall market is gripped by this global fear. You got the VIX spiking above 22. And yet, specific microcap sectors are seeing these, as the brief calls them, explosive, high-volume moves. Moves that seem to completely defy the generalized caution.
It creates this really fascinating scenario, doesn't it? Where a general risk-off signal should theoretically dampen speculation across the board, kill the appetite for risk. However, these specific, often geopolitical fundamental catalysts seem to be completely overriding that systemic caution in certain pockets. It really proves that money will flow wherever it sees a clear and, maybe more importantly, a defensible narrative.
Okay, let's dive into Section 4A then, the top pre-market gainers. What's the unified theme here? Because looking at the top three, it doesn't feel random at all.
No, it's not random. The key theme is incredibly focused. It's thematic. The top three gainers this morning are all concentrated in one specific area, the critical minerals and materials sector. This isn't just a market story playing out. This is the geopolitical trade unfolding in real time, right there on the NASDAQ ticker.
Okay, let's start with the biggest one. Critical Metals Corp, symbol CRML. This stock is surging, get this, over 55% in pre-market trading. What on earth is the catalyst that justifies that kind of move, especially in this broad risk-off environment?
The catalyst is a really definitive strategic move, and it's tied directly to national supply chain security concerns. CRML announced they signed a letter of intent, an LOI, for a significant offtake agreement. The agreement is with Realloys, Inc., which is described as a U.S.-based rare earth company. And this specific deal secures 15% of the future heavy and medium rare earth elements output on CRML's Tambreez project, which is located in Greenland.
Greenland. Okay, and this is where that geopolitical angle really clicks in, right? This feels like the aha moment. This isn't just some simple corporate deal for rocks. It's a strategic national interest play.
Precisely. This deal directly supports that whole Western initiative, the push to establish a resilient rare earth supply chain that is fundamentally independent of China. As you know, China has historically dominated this market, which creates a pretty significant strategic vulnerability for the U.S. and its allies, especially for defense applications and green tech. The sources highlight that this deal, combined with a previous agreement they already had, means that 25%, a quarter, of the Tambreez project's total future production is now committed to U.S. customers. So this isn't just about potential future revenue for CRML. It's viewed as a tangible commitment to securing vital materials for North American defense and industrial manufacturing. It makes the company itself a kind of strategic geopolitical asset. And investors are clearly now valuing that at a significant premium.
Wow, okay. Next up, United States Antimony Corp, UAMY. This stock is trading higher by nearly 37%. What's their story? The brief mentions a powerful confluence of news.
Yeah, UAMY is benefiting from a really potent mix of defense-related news. The main driver appears to be the award of a 5-year, $245 million sole source contract. The contract is from the U.S. Defense Logistics Agency, the DLA. And the purpose is critical, to purchase antimony metal ingots specifically to replenish the U.S. national defense stockpile. Antimony, is a critical element used in all sorts of things, from defense equipment like flame retardants and munitions to specialized batteries.
A sole source contract of that magnitude, from the DLA no less, that's got to be a massive institutional validation, right?
It absolutely is. It underscores just how critical antimony is for national defense applications. But what really seemed to make the news explosive this morning was the compounding signal of institutional confidence that came alongside it. UAMY also announced they executed a $25 million registered direct equity offering. And the buyer was a leading mutual fund. Crucially, the sources emphasize this point. The offering was priced above the market under NYSE rules. Now, when institutional money, like a major mutual fund, is willing to come in and buy a significant chunk of equity at a premium price point, especially in a volatile risk-off tape like today, that sends a powerful, almost undeniable signal of conviction. Conviction in the company's ability to actually execute on these massive defense contracts. And, well, in its strategic future, it's a huge vote of confidence.
Okay, huge validation there. Finally, rounding out this critical minerals theme, we have American battery technology company, ABAT, CT. They're up over 36%. Their catalyst seems more focused on process and regulatory progress, but clearly still incredibly important for these huge capital-intensive projects.
That's right. AB is celebrating what the market is clearly interpreting as a major de-risking event for them. They announced the successful completion of all 21 required baseline studies for their Tonopah Flats lithium project. This is a necessary part of the NEPA process. That's the National Environmental Policy Act.
Why is completing these baseline studies such a big deal? I mean, it sounds kind of administrative, almost bureaucratic, but the stock reaction suggests it's actually foundational.
So it is. It's a massive, potentially transformative step forward. It moves the project from just conceptual promise towards regulatory reality. These comprehensive baseline studies, they cover everything. Biological resources, ecological impacts, hydrological surveys, cultural resources. They are the necessary prerequisite, the absolute must-have. Before the U.S. Bureau of Land Management, the BLM, can formally initiate the actual NEPA review for what's described as one of the largest critical mineral lithium projects in the United States. For these big mining projects, especially lithium in sensitive areas, the NEPA process is often where they get bogged down, sometimes for years. It's a major hurdle. So completing all 21 baseline studies significantly reduces that regulatory uncertainty. It moves the project substantially closer to getting federal permits and ultimately to construction and operation. It basically takes the project from being just a hopeful idea on paper to becoming a more tangible de-risk asset with a much clearer path forward to potential production. Investors love de-risking events. So if we just connect the dots on all three of these huge pre-market gainers, CRML, UMMY, and ABAT, the conclusion is pretty stunning, isn't it? These companies are clearly trading on a powerful, maybe even secular geopolitical narrative. It's about U.S.-China strategic competition. It's about domestic supply chain security. They seem to be trading on that narrative as much as, or possibly even more than, they're trading on traditional quarterly financial metrics like earnings per share or revenue guidance. They have, in effect, decoupled themselves, at least for now, from the broader fear that's plaguing the rest of the market. Why? Because they're seen as solving a critical national security problem that kind of transcends typical quarterly earnings volatility.
That's a fantastic point about the decoupling. Now, let's shift gears and look at the downside section 4B. Top pre-market losers. These declines seem driven by very specific, quite different reasons than just the macro fear pushing the Dow and Nasdaq down. We need to look closely here to understand the specific risks lurking in different corners of the market.
We absolutely do. This shift really highlights that even on a down day, the declines aren't monolithic. They're not all happening for the same reason. You've got technical corrections after big run-ups, you've got unexpected regulatory risks popping up, and you've got, well, rumor collapses.
Okay, first up, Mercurity Fintech Holding, MFH, down over 21% this morning. Our source notes, interestingly, no specific negative news catalyst was found driving this. So if there wasn't some catastrophic announcement, what's behind such a sharp decline?
This looks like a pretty textbook example of a technical correction following a period of extreme volatility and, frankly, speculative behavior. MFH, you see, recently benefited from a couple of things like uplisting from the NASDAQ Capital Market tier to the higher NASDAQ Global Market tier, and then subsequent index inclusion. These events fueled a massive price appreciation, really parabolic, and likely attracted a lot of speculative buying, maybe from retail traders piling in, chasing what they thought was a guaranteed upward ride. So this sharp decline today, it appears to be early, maybe more sophisticated investors just taking profits aggressively, cashing out on what was a huge run-up in a stock described as low revenue, high concept. The stock's history, the brief notes, includes trading halts due to volatility in the past, which highlights its highly speculative nature, makes it extremely susceptible to these dramatic pullbacks once that initial euphoria fades or the fast money decides to move on.
Right, the classic up like a rocket, down like a stick scenario. Okay, next, let's look at a case that highlights a really crucial and sometimes hidden risk in the biotech space. Scholar Rock Holding Corp, SRRK, down more than 13%. They received a complete response letter, a CRL, from the FDA for their drug candidate, apitegromab. Now wait a minute, the brief says the rejection wasn't actually about the drug's safety or efficacy. That sounds like a massive logistical failure somewhere else. How often do we see a potentially promising drug get derailed by third-party manufacturing issues?
That is the aha moment here. And it's the critical nuance for any biotech investor listening. The initial headline sounds catastrophic, right? FDA rejects your biologics license application. Game over, maybe. However, digging into the details, the FDA's letter, the CRL, was issued solely due to observations the FDA inspectors identified during an inspection of a third-party fill-finish facility. This one operated by Catalent Indiana LLC. Crucially, the CRL did not cite any issues related to the drug's actual clinical efficacy or its safety data from the trials. So this perfectly illustrates a major third-order risk in biotech development. The systemic risk that comes from relying heavily on contract manufacturing organizations, or CMOs. Many promising biotechs, especially smaller ones, outsource their manufacturing. So a problem at a single major CMO, maybe it's a contamination issue, a logistical failure, a quality control lapse that can create this cascading negative effect across its entire client base. It can delay approval for multiple different drugs being manufactured at that same site, even if the drugs themselves are fine. The drug is safe, the data looks good, but the factory, the supply chain partner, failed its inspection. So the market is reacting to the immediate uncertainty and, the inevitable multi-month delay that's now required for the CMO, Catalent in this case, to fix the issues and get re-inspected. But the fundamental value proposition of the drug itself is so far unchallenged based on this news. It's a really crucial reminder for anyone holding positions in biotech. You absolutely have to check their dependence on these large shared CMOs like Catalent, because it introduces the systemic risk into what might otherwise seem like sound, data-driven investments.
That is an excellent distinction to make operational risk trumping clinical data, at least temporarily. Okay, finally, Protagonist Therapeutics, PTGX, falling about 9%. This drop seems tied pretty directly to earlier market enthusiasm, maybe even over-enthusiasm.
Exactly. This one is being attributed directly to profit-taking following a very rapid run-up. And what fueled that run-up? A rumor. Specifically, the rumor of a potential acquisition by Johnson & Johnson, which had been reported, apparently, in the Wall Street Journal. Now, when a stock surges dramatically, often adding a huge premium based solely on an unconfirmed rumor of a takeover, well, any delay in confirmation, any lack of follow-through news, or just growing skepticism that the deal will actually happen, it almost inevitably results in swift, decisive profit-taking. People lock in those quick gains. And furthermore, in this case, the negative pressure seems to have been exacerbated by a contrarian viewpoint. Weiss Ratings recently reaffirmed a highly skeptical sell rating on PTGX stock. This counter-consensus call likely stood in stark contrast to what was probably an overwhelmingly bullish consensus from most other Wall Street analysts covering the stock. It might have given hesitant investors, the ones who rode the rumor up, just the push they needed to exit their positions and book their quick profits before it evaporated.
Okay, so we've covered a lot of ground. The global synchronized fear in the big indices, the specific domestic bank anxiety driven by things like LLPs and NII, the massive real-time risk hanging over everything from Fed speeches, and then these explosive, geopolitically fueled micro-rallies, completely defying the trend. Let's try to pull it all together now in Section 5, Synthesis and Active Strategy. What's the overarching summary? How would you describe the current landscape based on this brief?
We are witnessing a really powerful collision. You have global pervasive risk aversion, that's the macro track, battling head-to-head with intense, highly thematic bullishness, that's the micro track, specifically focused right now on strategic critical minerals. These two tracks are, at the moment, operating almost independently, which means those traditional market correlations, risk off means everything goes down, they seem to have broken down, at least temporarily. The rules that usually govern market volatility, where speculation kind of dries up during risk-off periods, they seem suspended right now because of the sheer power of that geopolitical narrative driving the minerals stocks.
So, for you, the listener, trying to navigate this today, what are the 3 key inflection points that are likely to determine how the market actually closes the day? Where must your focus be?
Okay, 3 key points to watch. First, the 8:30 a.m. Eastern Time earnings release. This is the initial and probably the most powerful catalyst of the day. Will the bank report specifically those loan loss provisions and the tone of management guidance? Will they validate the recession fears? If so, expect an acceleration of the broad-based sell-off. Or, conversely, will they somehow show unexpected resilience? Maybe better than feared NII stable credit quality. That could potentially spark a sharp reversal in the future sentiment we saw earlier. Point 1, bank earnings reaction.
Go number 1, bank earnings. What's number 2?
Number 2, the Federal Reserve speeches throughout the day. This introduces that massive real-time event risk we discussed. The potential for policy signaling, just a few words, to instantly override the corporate news flow is immense today. A surprisingly hawkish comment from Powell, for instance, could easily negate strong bank earnings within minutes. Or, on the flip side, an unexpectedly dovish hint could send indices soaring even if the bank reports themselves were kind of mixed or disappointing. Watch the Fed speakers closely.
Got it. Banks at 8:30, Fed speakers throughout the day. What's the 3rd key inflection point?
And third, the performance of those thematic leaders. Can CRML, UAY, and ABAT, those stocks riding the powerful geopolitical wave, can they actually hold on to their immense pre-market gains once the broader market opens and the institutional money really starts weighing in? Their sustained strength, or lack thereof, will be a crucial test. It'll tell us whether investors are still willing to chase these high-growth thematic stories, even when the overall risk environment, signaled by that high VIX, is flashing deep red. If those leaders start to fade significantly after the open, it probably signals that the broader macro fear is winning the day, overwhelming even the strong thematic narratives.
Okay, so what does this all mean for you, the listener, in terms of putting together an active strategy for today? What's the takeaway?
Well, the big takeaway is that today demands an extremely active strategy. Passive index tracking, just buying the S&P 500, is likely going to be pretty ineffective because the market movement isn't unified, it's fractured. If you're focused only on the Dow futures going down, you're completely missing the geopolitical explosion happening in minerals. If you're only focused on those high-flying microcaps, you could get absolutely blindsided by a broad market collapse triggered by the Fed or really poor credit quality data from the banks. That elevated VIX above 22, it just underscores that risk management is absolutely paramount today. Traders have to be prepared for sharp reversals, what we sometimes call head fakes. You need to be careful with your position sizing, maybe smaller than usual, and ensure you have stop-loss orders in place or at least mental stops to manage the inherent volatility. Just being aware of the day's key event times, knowing the banks report at 8:30 a.m., knowing when Powell or Bowman or Waller is scheduled to speak, that awareness is essential for navigating what promises to be a really turbulent, news-driven session. You just have to be prepared to see correlations break down entirely.
Wow. This has been a really fascinating dive into what is clearly a high-stakes, definitely a two-track kind of day. We started with that pervasive fear gripping the broad indices, defined by the VIX spike and those futures losses across the globe. But we ended up discussing these absolutely explosive gains in strategic materials, driven by powerful forces like government contracts and geopolitical imperatives. The complexity here, the divergence, it just requires incredible precision and awareness.
It really does. And that leads us, I think, to the final provocative thought for you, the listener, to consider as you navigate today and look ahead. If the performance of these critical mineral stocks like CRML and UAME is now being driven more by things like governmental defense contracts, national supply chain security initiatives, and overarching geopolitical tensions, more so than by traditional quarterly financial metrics like EPS and revenue, then the question becomes, what other sectors out there might be silently experiencing a similar decoupling from the broader macroeconomy? Are there other areas where non-financial factors are becoming the dominant driver? What non-financial, perhaps strategic data should we be tracking next? Maybe data related to infrastructure spending, climate policy rollouts, national defense priorities beyond just minerals. Where might the next big thematic opportunity lie? One that could prove immune to the market's day-to-day fears about the Fed or the next inflation print.
That is a great question to ponder as we head into what looks like a very volatile trading day, something to really chew on. Thank you for letting us guide you through this deep dive into the bulls, bears, and the Bell Morning Brief. We hope it helps you stay sharp out there. We'll catch you next time.